What's going on, everyone? I'm Andrew, and I don't want to work anymore. And because I don't want to work anymore, I came up with a strategy for the NASDAQ based on ICT's first presented fair value gap. So we're not going to waste any time. Let's just get right back into it. And we'll jump on to, we won't go to the charts right away, but we'll go to my spreadsheet where I started testing this strategy and back testing it and just seeing if I traded just the first fair value gap that was presented every day, what would my win-loss ratio be? And I found that it was, so over like 76 trading days, I was up 539 points, which is not a whole lot, but decent. And then someone mentioned in a video while I was forward testing this that he took the second trade and had a great winner. So I was like, what is going on here? That was super weird. Did someone just send me a message? No. Anyway, um, someone, and then I was like wondering, okay, what would happen if I took the second trade, if I allowed one loser and see if I can get into another position. So I started checking that and I found that I did way better. So we will add two more columns here and we have now a sum of 3,617 points. I was like, that's super fantastic. And then somehow within all that, I figured out this strategy and I'm going to show you how you can now stack multiple positions and really bring up your points per day. So let's get into that right off the bat. So we're in the charts here. We're going to use actually the best trading day I've ever had, and that was on Monday. We're going to go to a 1 minute chart. I'll delete these just so we don't get confused, but this is how the strategy worked. We are on the E-mini NASDAQ, the June contract, and this is the ICT kill zones and pivot indicator. So it just shows your sessions basically. So this is New York, and back here, this is Asia, London, New York. Okay, so we're going to zoom back in. And if we traded the very first presented fair value gap, it would be this guy right down here. So the market opened up, we have balanced price range all the way through to the bottom, and this would have been our first presented fair value gap right here. Now what I found in the back testing, you guys can check this out for yourself, but this position would have been short. I do not wait for a retest into the fair value gap, and I'll explain that in a bit. As soon as this third candle closes, I enter the trade. And my stop loss goes 5 points above the first candle that created the fair value gap. So I'm going to draw that out so you guys can see it. 5 points above would be about 16,819, so that's going to be 16,821. Okay, that's my stop loss, and that's basically just to deal with the spread, because I have seen in the back testing, again, do it yourself and see what you find, but price can come back up to the first candle and almost touch it, but with the spread you just need a couple extra points, and those extra points is nothing to get cheap on. And as you can see, I was wrong on the first presented fair value gap. No big deal, we get stopped out, but this fair value gap originally, we're going to drag it out, gets inverted right here. We could have entered right here on a long, but I have also found, like I said, price can come back up here and still dump off in the direction that you wanted to go originally. So I allow the candle the stop loss to get hit. And as soon as this stop loss got hit right here, we were ready to go long. And that one is, where's the long position? The long position would be right there. So we went long, and actually, let's go to the spreadsheet. That was Monday. Oh, you know what? I may have even waited till this fair value gap was formed right here. I could have gone in sooner, but I waited for double confirmation. So we had an inversion and we had this second fair value gap. And the stop loss went now below this candle. I'll clear this so it doesn't clutter our view. And you know what? I'm going to turn the kill zones off. So I waited for this one to form. Stop loss went right there. And now we're off to the races. So now we're long and we are on side. Now, the way I stack positions is I wait for another fair value gap to be formed. And so we had a second one right here. Let's get out the box. So there was one right here. And you can't enter on that one because your stop loss would have to go below this candle here. Sorry, it would have to go below this candle right here. And then you would have double the risk. So you have to wait till you've gone up far enough away from your initial entry so your stop loss goes above the first entry. So that looks like, is it this one here? It is this one. So there's a gap right here, which means I made another long position as soon as this candle closed right there. And our stop loss now would normally go below this candle, but I just put it right here. And as soon as that happens, that stop loss is above our initial entry. So this stop loss can go to break even, and this, so you have no risk here, and now you only have risk here. So the initial risk was something like 100 and, well, let's measure it out now that I closed it. The initial risk was 193 points. Hold on a second, guys. I'm sorry. I'm missing here. I'm going to float on top. Okay. Our initial stop loss was 193 points. Now that we have a second position on, that stop loss is above our initial position. Our initial position stop loss goes to break even. And now our only risk is on position number 2 at 80 points. So much nicer and less risk. And we have 2 positions now going in on profit. So now we're going to wait for another fair value gap. And where we get our third one is right here. As soon as this candle closes, we enter one more time. And this stop loss would go below candle number 1 of that fair value gap, which means position number 2 goes to break even. Actually, position 1 and position 2 break even will go right here. We're going to make this one red. The color is red. Why aren't you red? Oh, the text is red. Red? Okay. So we got 2 stop losses, one for position 1, one for position 2, and a third one for position 3, and they're all on the same line. So the only risk now is on position 3, which is actually greater now at 130 points, but we will continue on. And what we ended up doing was creating another fair value gap right up here, except my computer froze at the time, and that was basically fortunate for me because I just ended up flattening the trade while I was in profit somewhere up here. But we would have been able to move this stop loss to about there, and position 1 and 2 stop loss would come up to there, and we would have, let's see here, we actually would have been safe. This would have retraced. We would have been pretty close. The low on that candle would have been 163, and our stop loss is at 159. So that's 4 ticks or 4 points. We would have been safe, and we could have kept on going all the way up to here. This could have been a mega size trade. So this would have gone to 0. All 3 stop losses would now go to here because of this fair value gap. And then we created another one right after that. Sorry, there's that one. Yeah, and then there's another one right here. So we would have moved up. The stop loss would have stayed. And then we have another one right here. And once we got up to here, you would have moved your stop loss up below this candle, right? So that's the 3 candles right there. We have another fair value gap here at the top. So then 1, 2, 3. Okay, the stop loss would have stayed right there. Why is that not right? No, we would now come up to here. And we do get one more way up here. Look at this. Which means now all 3 stops would have came up to here. And if CMC markets didn't freeze on me, we would have got stopped out with an accumulation of something crazy. This is why I don't set profit targets, because when days trend like this, you gotta take every point that you can get. So look at this, 1,000 points on position 1. Position 2 would have been 911, and position 3 would have been 688, for a grand total of 1,000 plus 911 plus 688, 2,599 points. Let's just say 2,600 points. Now, if you guys are looking for something better than that, I'm sorry. I know this strategy doesn't work on every day, but when you have trending days like this is when you make hay. And backtest it yourself and you'll see. But I was able to get 1174 that day, 268, 361, 273, 365, 456, 625. These are big trades, guys. 8.4 RR, 9.6 RR. You know, if I got the 2,600 points and what was our initial stop loss on that first one? 193 points. What is that for an RR? Here, I'll do it on the screen for you. What was that? 2,600 points divided by, just say 200 points for a stop loss. That's a 13R trade. I don't know what more you want, but that is how I do it. I do not wait for retracements. You don't always get them. I know the optimal trade entry is going to be 50% inside the fair value gap, but do you see any of these fair value gaps being retested, right? Like, I'm just going to delete all these so we can have a better picture. Like this first fair value gap, it never gets traded back to. Does this first one? No, it doesn't. This one? No. This one? No. This one? No. So I'm sorry, guys. If you're looking for a retest of fair value gaps, you're going to get left behind, especially on NASDAQ. And any other instrument, that's a different story, but it's not worth it for me. The strategy speaks for itself. We're just forward testing it now and trying to recreate, these results. So I'd have to go back to see what day I started live testing this. I know it's been about, it was the last week of March that I started. So let's just say from April 1st, we are positive 386 points. It's not great, but it's been a rough month. But these other numbers, totaling 208 trades, 72 trading days, 128 wins, 80 losses, 61.5% win-loss ratio. That's fantastic in my books. Almost 6,000 points, 82 points per day average, and a 4.5 R. If you guys got a better strategy, please put it in the comments. Give me a like, give me a subscribe. Catch you guys next time.